Today is Wednesday, August the 14th, and it wasn't a tweet that brought the market down, but it was the inversion of the bond yield curve, which means that the 10-year rate of investing your money is now lower than the 2-year rate. So why would anybody invest long term? That can lead to an inversion. That can lead to a recession. Apparently it has in the past, but both Greenspan and Yellen don't think that that will happen this time. Notice how Ben Bernanke is so quiet. Gotta respect that guy. Yellen has been pretty quiet. Greenspan is on TV whenever he gets the opportunity. So the Dow was down 800. It could have been worse than last Monday, but look at the volume. That's pretty convincing volume. Pretty convincing volume in the NASDAQ and pretty convincing volume in the S&P 500. So higher than the 20-day moving average in all three respects. Blood on the streets. I don't see any green in there at all. Decliners led advancers by a factor of, I would say a factor of, 9 to 1? Anyways, huge. 80% of the stocks were down. That is going to take our oscillator, which, let's just refresh this here, which had moved up here, is going to take it down now to this 100 line for sure. So if we don't get support here, we're headed back down to an oscillator moving average of being really oversold. And we don't normally stay there very long. So we can see a bounce, but we could go further. So there are some really interesting things to see in the charts, and this is going to show you why technical charting is such a great thing. Let's look at the S&P 500, which finished off 85 points. So that is worse than last Monday when we finished off 76 points, 75.95. So this was worse. But what is interesting about this? Last Monday's drop hit 68.1. Then we had another intraday drop on the 7th, which would have been Wednesday, that touched the 68.1% retrace of this high and this low back in here of December, just the day after. Well, this was December 24th when we hit our low, and that's where we drew our low point. So December 24th to our high point of July 26th, we've pulled back 68.1% and had a bounce. But we're below the 200 exponential moving average and above the 200 simple moving average. So the Fibonacci lines are more important now than finding support at the moving averages. But what is also support? Let's get rid of the cloud for a second so we get rid of some of the clutter. And let's go back and let's look at some of our older head and shoulders. We saw this most recent head and shoulders was almost rejection, but this left shoulder right here, and there's the neckline of the shoulder. Here's the head, and here's the neckline of the right shoulder. And we drew that line across quite a while ago, and we found how it played a launching point to this high. And then we came back down and we tested that neckline for several days and went back up to form a new left shoulder. What we've done now is we have come back down today to test exactly that same head and shoulders neckline that we tested back here in the middle of May. We responded to the neckline, but we came down and we sought the 200 simple moving average and the 200 exponential moving average, which were at the same point. and actually spent a couple of days below that value. So is this going to prove to be support, or are we going to go down to the 68.1? At some time tomorrow in intraday trading, we will be going back down to 28.24. But after such a big move, we said last Monday after such a big move that we would see a bounce, and we did. It's quite possible tomorrow that we see a bounce because this is huge selling and there are some opportunities for buying out there. Apple being one of them. Apple finished at the low of its candle today, so that is not encouraging. There could be still more selling, and the 50 exponential moving average could be attractive. But I still have only 200 shares. I normally carry about 1,000 shares to 1,300 shares. But when I started at the beginning of the year of selling puts instead of buying shares, I never had more than 300 or 400 shares of stock. So, at least I don't think so. So now I have 200 and I have no short calls against it. So that means that I'm mildly bullish on Apple, but I am not jumping in. Caterpillar continues to be ugly for all the reasons we've said, and they all have to do with tariffs and China and global trade. And you can see this gap down here from July 24th, so that would have been second quarter earnings of last year. I think we're going down to at least test that. Let's take this fib extension and draw it across and look at that. We've hit 50% exactly halfway of this move up from January of 2016 to January of 2018. We had this massive surge up. Ooh, we've got another gap that we can look forward to in the future. But let's deal with this gap first. It does look like, if we take the Ichimoku out and just clean the chart up a little bit, it does look like we're coming back to test this low, which is the top of the gap, and that would be 111.43. I have some short 120 calls that are 16 days away on half my position, and the other half I don't have any short calls on because it's just not, there's just not enough premium in them, and I'm still holding on to stock. But I have an opportunity, because I've been holding on to cash, of buying some more Caterpillar. And I will be looking to buy if we go down to 111.65. That will be a nice place to buy if we get support. GDX, I haven't added any more GDX. We're still in the range. I would like to see a bounce back into the range and maybe nibble a little bit more. Banks had a horrible day. U.S. Bank not one to, we're at 50% retrace here too. So the bank's just terrible. Whirlpool, horrible, but a good company, well-run company, good sales, good margins, but there's the consumer threat, and that's why we're seeing this fail. We could easily go down to 68.1, but look at the Chiku span. Almost came down to get support on the cloud. Could find support on the cloud tomorrow. So let's look at this. Let's set an alert on Whirlpool for, let's not do an indicator, let's just do price, and that would be the top of the cloud. Where am I for Whirlpool? I have 1,100 shares. Do you remember yesterday I got bullish with this high move and it came back to retreat to below the 200, but I bought some stock. I bought 400. Sorry, I bought 300 and sold next week's 140 calls against them. I sold them for I sold this week's 140 calls for $1.13 on 400 shares. I was able to unload 3 of those contracts today for 6 cents. I have one left at 2 cents, so that's going to obviously expire. But it's these 130 calls that I've been holding, and watching the stock run away from me. I just didn't want to lose the stock. I couldn't cash them in. I didn't want to take the losses, so I just started selling calls well below where I paid for the stock. I paid over 145 for the stock, so I started selling 130 calls like crazy, and looks like that's going to be a winner for me. That now has a $2,600 profit on those 130 calls, 4 of them. We're at 129.82. So let's see if we can hold on to those 130 calls. They've got 2 days left in them. They're worth negative 12 cents, but they are actually going for $1.81. So there's way too much premium in there, and that should eke out tomorrow. And I might have an opportunity tomorrow to get out of those or roll those 130s for more premium. I will tweet what I do with that, but it's been interesting.